Hello,
Yeah,
sir.
Someone messaged me.
It started, sir. It started.
Very good evening, members. It's a technical reasons we are starting with this program. Today's live webcast about 10 minutes delayed. Kindly excuse for the inconvenience. The today's topic is COVID-19 financial reporting implications. We have with us an expert speakers on the topic, CA Asha M and CA Ajith Thambi, on behalf of members of Bangalore branch and managing committee of Bangalore branch and the viewers. The last 2 days are about 600 and 400 live viewers are viewing this program across the country and a few from abroad also. So I welcome you all also for this program. So CA Asha M is an and CA Ajith Thambi are going to enlighten on the subject. Very important topic, COVID-19 financial reporting implications. And coming to the next programs, we have on 20th COVID relief measures for GST compliance by CA Venugopal. And after that, 22nd also we have live webcast, 23rd also we have, 25 also we have. So I request members to keep on view the live webcast of Bangalore branch. So coming to today's topic, I once again heartily welcome CA Asha M and CA Ajith Thambi for this program. So welcome you, madam, and CA Ajith. Kindly over to you, please. Take over the session.
Thank you, sir. Thank you so much.
Thank you, sir. Thank you. Yeah. Hi, everyone. Good evening. This is Ajith Thambi here, a chartered accountant. I work as a financial accounting reporting consultant. First of all, hope you and your dear ones are all safe at this point of time. And I would also like to thank the Bangalore chapter for giving me this opportunity to share my views and insights. So what we will do today is that we will have a look at on some of the emerging concerns due to this COVID-19 on the business as a whole. Then after that we will also look into some of the global surveys to which actually gives you a reflection on what would be the impact, and also we will look into some of the impact areas specifically for the finance function. After that we will actually move into the main area, that is to discuss on the entire key impact areas which actually relates to the financial statement and the related disclosures. So at that point of time, I think Asha will take over. What we will do after that is we will also look into some of the critical audit considerations at this point of time, and we will just also have a overview on some of the regulatory relaxations that has been provided by the government considering this situation. So let's actually get started with an overview. So we are all familiar with this word COVID-19 by now. It's nothing but we all know that it's an infectious disease which is actually known as a health pandemic disease. But even though it is a health pandemic disease, eventually it is actually resulted in a kind of a economic pandemic, or say an entire business pandemic. So none of the nations have ever experienced this in the past, and even as we for the kind of downfall and there is no precedence also, and the impact has been tremendous actually on public health, resulting in breakdown of the economy. And it has been extremely difficult also for one person to actually to predict or even estimate by when we will actually recover, or even to gauge how long we will actually take to recover from all the damage that has been caused, right? Because we also know, at this point, if you're looking at the kind of infected cases, it all started with China, and today as we speak, US and Europe has taken the bigger share, whereas actually China has actually taken a back seat. And unfortunately, most organizations around the world are also finding it extremely challenging to navigate through these difficult times. So let's just take a pause and just look even before this entire outbreak, actually how this situation was. So we all know that even before the outbreak, if you actually look, the economy was in a way, actually, it was volatile and it was also uncertain. It was extremely dynamic, with a lot of complexities, be it changes around business models, changes on the kind of compliances, a lot of even business models evolved during this time. So we know, like some of the business, which came in the recent years, like be it like the Ola or Uber or and all the e-commerce platforms. So no one even knew that all this will happen. So at some point of time, if you look, all the people were actually talking of globalization. And now, if you see, slowly, from this globalization, nations have been actually trying to see how they can be more dependent within themselves. So, which means that going forward, you can see little more of localization happening, more of actually trade barriers that has been happening. In the recent days, we have also seen, due to technology, how things have actually changed. The way how classes are conducted, the way how meetings are conducted, trainings are conducted. We even didn't actually expect this to happen. And I firmly believe that, side by side, a significant change that is going to happen during this outbreak situation, by the time actually we come out, will be from the technology side. So I would like to actually call this more like a, a kind of a technology revolution which is going to happen. And technology is something which is actually going to play a major role. So I was just actually talking to, one of the key counterparts. So they were actually mentioning that now the company is actually expecting that only 25% of the workforce going forward is going to actually work from office, and which means that the balance, entire workforce will continue to work from home. So having discussed these areas also, let us actually see some of the key emerging trends actually that has happened. If you look at some of the emerging trends, there has been concerns over health and safety, because health and safety is actually of primary importance. We all know that all the public entertainment venues, all the themes, all the parks, all the theaters, all has been closed for human safety. And the second important area is workforce, which actually India has never experienced this in the past. All the workforce have actually been working from remote locations. There has been actually challenging times to maintain, the productivity of workforce. All this is actually becoming a concern. The third important area which we are seeing as a concern is, the low level of demand of many of the products. Right? Apart from the essential product, we see that the demand levels generally has actually fallen down. Supply chain, which again we will be discussing. So supply chain, if you look, in order to optimize cost, if you see in the recent past, many entities had actually structured their entire supply chain, right? They actually worked on a kind of a economic order quantity, like where they will order their inventory only just in time. They wanted to make sure that only low levels of inventories are actually maintained. Only selected vendors were actually engaged. Now entities are actually looking more from a broader perspective to see how they can manage this entire supply chain. So lastly is, the entire area on this increased social responsibility of organizations, where entities have been trying to help the community in a way actually how they can see. While having, mentioned on all these concerns, we also know that there is also an upside of this risk. Some of the entities and some of the organization sectors have actually, in a way, gained. So what I feel is that, some of the home entertainment and the social media companies are seeing actually uplift in revenues actually for a change. Now we do not know whether this pattern is actually going to continue, but at least we know that, this is having an impact. So in a way, if you actually see, one could always ask, is this actually a kind of a world war, with a kind of an intangible, with a virus, or is a kind of a World War III, which actually we are seeing, right? And also, I would like to take you through some of the recent surveys. These are also some of the, the macro level surveys which is actually conducted, where, people before this entire outbreak, people was expecting that, at least, like 47% of the people expected that there's going to be a positive change in this current year. Okay, and out of that, say around 35% people expected that it's going to be stable, and some people expected that there is going to be a negative kind of a growth. But after this entire virus outbreak, if you see that many people have actually gone back, and they see that, there are very less people who are telling that now there's going to be a positive change. But at least, we know for the fact that all this is going to be only a kind of a temporary, a kind of a hit, but in the long run, actually, they should be taken care. So similarly, even on the impact on profitability and margin also, entities, this is going to have an impact on many of the sectors in which actually companies are working on. So another kind of this analysis was this entire the amount of investment that entities are going to make due to this technology. So if you see, many of the companies are already working on what it can actually work with this entire technology and see how best it can actually be benefited in this entire exercise, right? Now, actually looking into some of these sectors, now actually looking into some of these sectors which has got actually impacted. Now, we all know that most of the sectors have got impacted, but again, looking at the volume, at the impact level, we can actually tell that some critical 5 6 sectors has got actually seriously impacted. So one is travel, tourism, hospitality. So we know that because of this entire restriction on travel, that sector is actually impacted. But again, it will take some time for the sector to actually come out. Similarly, the entire airline and shipping industry has been severely impacted. There has been very, very minimal cross-border transactions, while the business is impacted for many entities because certain costs are actually remaining the same. So we all know that most of the airline industry or the industry in the shipping. So the lease contracts are very, very predominant, and it's very, very critical for them. So wherever, especially in airline industry, you will see that the entities will still continue to incur costs, whereas they know that the revenue is actually almost zero. So these are all some kind of the important sectors which can have an impact. So financial sector is again a very, very key challenge. Again, I will tell that that is a kind of a function of all other sectors as well. The key challenge in the sector is today, as we speak, is is on the entire liquidity crisis, and many of the financial sector entities having a challenge in even estimating what would be the realistic expected credit loss in the future. Right? We all do not know, because as we speak today, because many of the cash flows have got impacted, liquidity has got impacted, we do not know whether the customers will actually pay off the debts at this point of time. So similarly, I think on the entertainment sector, actually, we spoke, so that is an area with also significant impact. Automobile sector is again, at this point of time, it is impacted. But again, we also know that when we speak of automotive sector, there are a lot of ancillary industries actually attached to it. Even they are also affected. But probably after this entire crisis is over, might be the expectation is that either the individual, say the individual orders might increase on automobiles, or if not, then the kind of orders from all the car rental companies and the hire companies, from there the orders can actually increase. Oil and gas, we all know that even before the situation, the global price of crude oil had dropped, but now it has actually dropped even more significantly. This drop, even as I told, it started even before the entire outbreak. So now the COVID-19 has added more to this complication. So we only need to wait and watch and see how this will be actually dealt with in the future. Now, coming to on precisely on some of the functions that is impacted in a business. So while I actually focus on finance function, so this is also something which is impacted the business as a whole. So while we speak, we can also relate this, with the finance function as well. So starting with workforce, so we did actually mention on this. So there has been a mandatory work from home. We are all aware of this. Many all the entities are, even by the requirement of law, we all have been actually working from home, at least from the lockdown since March 23rd onwards. So organizations have been struggling to ensure that first of all the necessary infrastructure is there at home, all the employees are connected, and all the information is available on a timely basis, right? So there are actually challenges, to manage, especially employees who are working on hourly basis, to see how much of productive work actually they have put in. So many entities have been facing challenges on this. So now also companies had to ensure that while the employees access to the organization's network, how much of the security protocols has been taken care. So I think this is also one of the challenges where many of the entities have been working on. So certain challenges have been observed where in case where the physical workforce is involved, in case of labor intensive the industries, so that could be a kind of an impact where actually workforce has been, because of the people that have been working remote. So now the latest issue, actually, what we find is that when we, in fact, talk to many of the clients, is that now people are thinking that when the employees resume work, what pattern will they actually resume work? So if you remember the way how employees started to work on a remote location, it was all in a phased manner. So people actually started to take shift. Actually, people started to work on alternative days, and similarly now it is a complete shutdown. People are all working from home. So similarly, when this entire operation is resumed, there will be a complete analysis study which many of the entities have been even doing to find out how many percentage of the employees will actually get back to office and under what timelines. So that will actually play a major critical role. So and we also know that as we speak, two of the tech companies, right, like say like Wipro and TCS have already published the results, and this entire thing is that actually happening. This actually happened because of people, in spite of actually working from home. So that is one area on the workforce front, and also entities, need to give a great amount of attention on the cyber security control. So which is also going to be very, very important. Now, on the second area is on the financing bit. We all know that all the entities have been functioning, and finance is obviously most required, right? It is the most vital, important thing for any business to actually continue. Now, if you see, many of the entities have been leveraging on the alternative credit line, on the alternative credit line, and also taking additional credit facilities from the bank. So having said that, many entities were also prepared to go in for an IPO, right? They were all geared up. So now, because of this entire situation, we find that the valuations can have an impact. So because of which the entire IPO roadmap or the IPO journey will have to be postponed to a future date. So many of the M&A deals, the merger and acquisition deals, at least for the time being, has been paused, and this will also have to be considered for a future date. Getting on to the third area quickly is on the entire impact on the working capital. So working capital has got actually significantly impacted. Many of the capital expenses has been deferred. When I'm talking of working capital, the collections has been impacted because many of the customers has postponed the payment cycle. So similarly, entities are also reworking on their payment cycle. So all this will actually happen a complete circle, right? It is a entire your entire cash cycle has actually got impacted. Then the last area actually, which from a more from a finance function, which you'll have to look into, is your customers. Ultimately, you're all be doing business, and towards the end, you will need your customers, to exist, and also customers to continue, and also see ways to how we can enhance your customer portfolio. So there has been a pressure on the finance function as a whole, especially to follow the customer on the accounts receivable, enhance your future sales orders. Entities are all reassessing the credit risk, as I mentioned. So entities need to actually ensure that there needs to be a constant dialogue with all your customers. So for this, many of the your contact centers needs to be actually, the capability of contact centers needs to be actually increased at this point of time. So finally, in a way, if you actually look at it, what will happen is that all the people will actually get used to this kind of a phase. They will get used to newer technology to see how actually business can be done in newer ways. And definitely this is going to be a transformation journey for most of the people actually working. So now actually getting on to the the regulatory compliance also, there has been quite a bit of relaxation provided by the government. So we will actually discuss that at the later part of the session. Entities have been finalizing the timelines for declaration of earnings, and at what point of time will they have investor analyst call. So all this has been discussed in greater detail. There has been serious discussions, with the board members on timing of when to hold meetings, and demonstrating, with a clear kind of a roadmap on how the finance and reporting team will close remotely, with the current challenges, while they maintain that all the communication protocols have been followed. So this is where actually we stand today. But I'm sure that this will be a great transformation, and it will evolve over a period of time, and we will actually get away with it. So now, I will just hand over the session to Asha to actually take us through on the key impact areas for on entities when you actually prepare the financial statements that will have a major role. Over to you, Asha.
you, Ajith. Thank you so much. It was quite enlightening to me as well. It's good to kind of hear you after a long time. Good evening, all members. Thank you so much for making time today. It's a virtual session. I think it's my first virtual session of ICAI. It's quite difficult to be in front of screen and imagine that I am seeing members and speak, but I'm sure I'll make my best effort to walk you through on the topic. Continuing with what Ajit mentioned, I mean, just a small story to the members to share, the journey of this COVID, how it started. Like 2nd of March, I was in Delhi for an official work, and then 10:30 a.m. in the morning, we were having discussion with a large gathering, and it was some felicitation program. And then we just mentioned that what happens if this coronavirus comes to India, it's going to be really, really disastrous. And then we said, thank God, it's not there in India, and we are quite happy. That was like 2nd of March. And on the same day afternoon, there was one case, which Delhi government actually came up and said, okay, we have one person who has come from some part of the other country, some part of the world to our country, has actually diagnosed with COVID positive. Now that's where the journey started. I was back to Bangalore on 7th of March, and then from then to now, it's a roller coaster. I'm sure all of us are facing these troubles. It's not a normal life. Social distancing is not very easy. It is definitely disruptive to all of us. But what is really good about I think all chartered accountants and members and all our communities, we are eager to learn no matter whatever the situation is, right? We kind of find out our own ways of learning things, our own ways of exploring things. And then I think at least from 15th of March to now onwards, I'm only working on COVID-related research documents, accounting implications, financial reporting implementations, working closely with some of the global counterparts to see, what kind of implications they will have on US GAAP, IFRS, right, and the country-specific local regulations. I mean, to continue to say that, I'm just hoping all of you are also doing good, and then I'll talk about few of these implications. The idea was just not to disrupt, to say that a lot of things are changing. The idea is just to enlighten members that, okay, having said that COVID has impacted a lot more sectors in different way, it's definitely impacted our own profession in a big way. In my personal view, I would not, be surprised if you want to call this as accounting change by itself. There's every standard that we would have converged from IFRS to Ind AS, ideally, has got impacted on account of COVID. So I will walk you through on some of the reporting implications. This is based on a last 1 month extensive research on what we are hearing from the FASB, IASB, ICI publications, and what we're speaking in the market on clients. Right, so these are some of the areas that you see on the screen are impacted. These are high impact areas. I haven't really, with the interest of the time, got these small areas for topic of discussion, but I'm sure some of you in your reporting closure for March ended would be discussing, or maybe would be researching or talking to your auditors or consultants to ask what could really change for us. And maybe we thought this snapshot of some of the things that we have been researching would help you to have a smooth closure virtually this time. Right, so these are some of the impact areas. Asset impairments. I think obvious that all of us are hearing that there's going to be a huge implication on account of an impairment. We'll talk about what clients are doing and what kind of scenario analysis they're trying to do. I mean, is there some developed models? The answer is no, but everyone is struggling to project something. The entire economy understands that there is a disruption and there is going to be an impact. There's no one who is denying to the fact that it's not going to be a great impact. Everyone knows there's an impact, but what people are talking is the degree at which it would impact. Some sectors are comparatively better off. Some sectors are comparatively badly hit. Some sectors are actually fairly break even. Okay, so that it's all about which sector they fall in and what are they trying to do, what are they innovating, what else business models they're bringing into their business to come out of the situation is what the whole world is dealing with, including the consulting firms. Everybody is trying to see what we can do to get back our normal margins and get back to a normal pace as soon as we can. And so that's one area that we will deep dive. Loans and investments will have an impact on account of some of the areas which Ajith already mentioned, that there is stock market disruption, IPOs are already on halt. We are finding that business combinations are at this point of time just being muted. Not many things are happening on that side. So there are quite a few small and medium sector enterprises whose investments may not yield what they were supposed to yield. I'm sure you must be watching the startup story. Startups I have a huge cry at this point of time because they've promised lavishing returns to the investors, which they find very difficult to achieve. I'm sure some of the startups, don't want to take names, but some of the startups are coming up and then they're actually confessing that this is quite painful for them because they have IRR that needs to be achieved, and all the gig economy startups, which could include even the transportation, hospitality industry, or all of them, I think, never expected that this will change their business models and could impact them at some point of time. Co-working spaces, right? Everything which was around social gathering, I think is hugely impacted. So we'll talk about loans and investments. There are certain assets in few businesses which could have dispositions or which could actually have disposals. Maybe some parts of the business may not be doing well, and then they may consider actually shutting down that particular stream of the business, or they may consider actually revamping the whole business model for certain parts of the business. That's something that one has to look at. How will this particular COVID-19 will impact their structurings? So from accounting perspective, I will talk about that. Acquisitions, fair value measurements, hedge accounting. This is one of the most spoken topic across financial services sector and sectors who are hugely dependent on derivative instruments. We will talk about how will it impact from an accounting side. Debt modifications. So what will happen on account of this pandemic? We already know that the banks have given 3 months moratorium to all the individuals and to the people who are actually having loans. But would that stop there? The answer is no, because of the impact on the cash flows. The lenders might get requests that they want some kind of modifications to the loan covenants. They want reduction in interest payments. They may expect them to come out with some kind of relaxations in the debt, which is owed to a bank. So government may interfere and then, make a loan interest free. This is already happening in some parts of the geography. There's a bank which is already helping people to get interest free loans, just to kind of help people in this COVID-19 situation. Now, how do we really account these interest free loans? I'm sure if some of you would have read, US has CARES Act, right? They've come up with Coronavirus Aid, Relief and Social Enforcement Act. So the CARES Act in US actually is big time introduced only to assist and provide COVID relief. So now what will happen because of this CARES Act? There's a huge amount of government assistance, stimulus, right? The government will end up giving some kind of reliefs and relaxations to the organizations. And what I've been hearing in some of the countries, not yet in India though, but in some of the countries, the government has started, giving them the reliefs, and in compensation, the organizations are giving them some kind of sovereign notes or maybe structured debt instruments or some kind of securities to the government organizations, which is something which from an accounting perspective, we have never evaluated. So we need to come out and see any relief from the government, would it qualify to be a government grant, and how do we record that grant? Foreign currency matters because of the unstable markets. Now, foreign currency is going to be another impacted area from a financial reporting perspective. EPS, EPS is, if you're thinking from a diluted EPS perspective, convertible instruments, optionally convertible instruments, right, convertible at the option of the company. So these are these hybrid instruments which were considered for computation of diluted EPS. Now, on account of changes and modifications to the instruments which may happen with negotiations over the period of time with the stakeholders, might have implications on EPS as well. I will definitely spend some time on revenue recognition, maybe a little larger time than the other topics, considering the implications the revenue standard has on account of COVID-19. I'm sure I think some of you would have already been researched around this, and happy to get some comments from you if you've already done some research. The most impacted topic, or maybe a word that we are hearing on revenue, is force majeure. We've been hearing that the big corporates are invoking the force majeure clauses, and then trying to see that, how can they call it as an act of God and then make a contract void for a certain period of time. Hence, they can be discharged from the obligations, at least at this point of time. So we'll have to see the accounting implications from that perspective. I don't think so we need to reiterate, but many organizations who are expecting to be profitable this year have actually, I think, estimated that they may incur more losses, maybe at least for 1 year to go. No one knows how is future going to be, but because of an uncertainty, there's an expectation that the future operating losses might increase. Now, how will this impact accounting? Future cash flows are input to many accounting standards, may it be impairment, may it be leases, right? I mean, may it be any kind of fair value measurements we do, recoverability adjustments that we do, right? DCF is one of the most important input to the accounting statements or financial statements. Now, if we see that these operating losses are going to increase further, it may so happen that some of the contracts which were profitable and hence been recorded as the normal contract would now turn out to be onerous contract, and they may have to recognize the losses upfront. Right? Leases is another impacted area. We will speak about it. Retail industry, airline industry is big time impacted on account of leases from an accounting side. Insurance recoveries, this is another area where, would the insurance covers the loss of revenue, covers the loss of properties, covers the loss of, on account of non-utilization of property, plant and equipment, there are inefficiencies, would these kind of losses are covered in insurance? Actually, this becomes a contingent income unless until it has been, it has been certain that we will receive from insurance companies. So insurance is one area one has to watch out, that unless there's a certainty, there could be a contingency involved to recognize an income in this area. Compensations, I think, is one another area. There will be negotiations with employees. There will be negotiations. I mean, I have been hearing, I'm not sure that how much, it would really come into practice. But what I'm hearing is that maybe, people who are in the verge of retiring might be given some compensation and been asked to retire early, just to ensure that, they will not be able to take, if they think that they don't need, the workforce going forward in that scale, they might, I've been reading this in some geographies that they're already started some post-employment benefit plans and termination plans just to help people to retire early, and then to see how they can actually minimize their workforce cost. ESOPs is another big hit area. ESOPs, because of the valuation models. Now, what kind of inputs the model will take? There's a huge volatility in the stock prices. There is huge volatility in the market, right? The options could actually become, non-usable. Option could actually become out of money. How does the models will take this kind of computations? Would even somebody can use, those models for ESOP computation, which we used to use earlier, is a question now. Income taxes is one of the impacted area. I think I'm just kind of highlighting. We will go deep dive into these areas. Government assistance and bankruptcy for some companies who may not be able to survive and have to shut down their business because of the going concern implication, might have to go for an insolvency proceedings or a bankruptcy proceedings and start afresh again. So I have been hearing in US, the bankruptcy and a fresh start is one of the most emerging topics. There are quite a few solutions, around that is available in US to say, how do we assist you to just shut down what you've been doing it and then just restart something afresh so that you don't have to carry those losses forever and then suffer to show profitability going forward. So these are some areas, which I could think of. I have just noted, but I'm sure we are also evolving with the way, with the way I guess uncertainties are going. We're evolving. We will get more and more topics, I think, to discuss as we move forward. But at least with the research that we have done in the last couple of days, these are impacted areas upfront that one can think of. So with that, I will deep dive into each of this area in terms of what one has to consider. I'll try and see how much I can deep dive and then how many inputs I can give, but I'm happy to take, some questions, live comments, or if you have some specific areas. We may not be able to answer business specific questions in this particular call, but happy to share inputs wherever you feel that you need some inputs to do that. Now, asset impairment, just going back to our previous slides, I'm just going one by one area and then seeing what impact will it have on the financial reporting side. So how does the asset impairment, would impact, how does even asset impairment comes into picture in a COVID-19 situation? As we all know, there are two types of intangible assets under Ind AS 36. There are definite life intangible assets, which includes, brand, copyright, etc. There are some indefinite life intangible asset, which Ind AS allowed to recognize in the financial statements. One point for all the members is there's no amendments on these standards on account of COVID-19. We're not talking anything new. Nothing in the standards is changed, but it requires a revisiting of the standards and reinterpretation of few things, and maybe reopening of the contracts to see what impact this will have going forward. Otherwise, we do not see amendments specific to COVID area at all. These are all something which we all know, but because of the situation, the emphasis of these standards is increased. So what will happen now is all these long-lived assets or indefinite intangible assets, one has to assess that, would people even spend money? I'm sure we are all reading that, the discretionary spend will come down drastically unless the economy stabilizes. Including me, I don't want to spend now on things which are not really worth for me. And we all know that we just want essentials at this point of time. Luxury and etc. has just been taken a corner side. Everyone is thinking that, okay, let's just things get secure, let economy get stable, and then we'll start buying luxurious items. So considering all of these kind of change in the consumer behavior, right, change in the economic activities, we know that all the restaurants, right, malls, and wherever there was a social gathering, all the gaming companies, media companies, entertainment, all of them are impacted, big time. And those people who actually developed an intangible to recognize in the books, considering an X amount of a revenue in the future, now has to revisit. Now, I'm sure the question which I've been getting these questions from the, from the clients, that how do we do this? Okay, we all know that this is asset impairment exists, but how do we do this? There is no one answer to it. It is very case to case, facts and circumstances. Having said that, the one thing immediately that I could think of is that you just have to open the Excel file where we did impairment analysis last time, see the assumptions which went into that file. Each assumption has to be challenged to the management, if you're in the position of an auditor, and the management has to cross-question themselves that, will I achieve this growth? Okay. Will I achieve this particular cash flows? Will I achieve, will I be able to expand the way I thought I would expand earlier? Will I be able to get to new centers? Will I be able to scale up? These are all the, assumptions which has gone into an impairment study, has to be revisited. And with some source of information available, and the survey which is available in the market, and with some economic factors available with us, one has to document that this is what we believe that is going to happen. And therefore, impairment may or may not exist according to us. But what I have been seeing in another good approach people are following is getting into a scenario analysis, because it's very difficult in an uncertain time to do a most likely output, right? I cannot say, okay, 10% is an expected growth last year, now I'll cut down to 5%. We don't have a reasoning or a logic to say why it's 5%. Now, hence one is getting into a probability assessments and getting into multiple versions of scenarios, best case, worst case, normal case, and whether it is a, it depends also on how economy grows. Is it going to be a U-shaped economy? Is going to be a V-shaped economy, or it's going to be a L-shaped economy growth? Now, what does it mean? U-shape is where once the pandemic stops, we will immediately, or rather V-shape is where once the pandemic starts, we'll immediately see an up curve and everything gets normal, within certain timelines. That is definitely an ideal state to be in, but not many, economists are expecting that we will have a V-shaped growth. But what is U-shaped growth is, once the pandemic gets settled, it will be stagnant for some days, and then it will just pop up again, and we'll slowly get into a curve of going up, which is also stable situation, which is good for us to actually get in there. But what is really a worse situation is L-shaped, where we see that the pandemic stops and we don't see the hopes of growing economy. That is one thing which no one knows. I mean, no one actually is giving the numbers which are exactly the things that we can pick up, but one can do a scenario analysis of, in these kind of growth economy, how do we really do an impairment, and then get into probability assessment and document each judgments. To point to all the members here is, it's not about what we do which really matters in this situation. What matters is how elaboratively and how nicely one can document to back up the assumptions, because its situation is such uncertain situation that no one will even know that what will happen after 10 days. So the assumptions have to be documented, logged, dated, revisited on a regular basis, because this indication is not one-time indication. This will continue unless until we see some signs of recovery. So these are some thoughts for asset impairment. All the intangible assets in the balance sheet has to be just revisited, right? Goodwill has to be revisited, especially the companies who acquired business combinations recently, right? The one who actually somebody who, I'm just looking at the question, somebody who actually got into the business combinations of late, and who recorded a huge amount of goodwill, thinking there is a synergy which will happen in the company, might have to now revisit the goodwill. I've been actually told by certain CFOs that if we want to take a hit of goodwill, we will take hit of goodwill right now. There's no point of taking a hit in coming days, because we know that next 1 year is not going to be a year where one can take profit or EBITDA as a KPI to look at, because everybody's profit has impacted. So the thought in one school of thought is, if we know that it's going to impact, let's just put the goodwill impairment in P&L, because we know that we may not be able to recover. Another school of thought is, no, this is just temporary. Even if it's 1 year, it's temporary, but gradually, slowly, we will expect that we get a synergy, and hence we don't want to take a goodwill impairment hit. Now, this goes back to the valuations that you would have got it done. One has to revisit the valuations, customer contracts, customer receivables, right? And the considerations that the negotiations which went behind paying that purchase consideration just has to be revisited to see whether the goodwill which is recorded as a goodwill actually carries the worth going forward. And it also depends on the type of industry. As Ajith mentioned, some type of industries are still okay, better off. They're not really struggling so much, but some type of industries are not seeing a very immediate hope, right? So it all depends on the facts, circumstances, the service sector in which the organization is in, right? And the consumer psychology to which they have to deal with, stakeholders, investors. A lot of matters will play a role when one has to impair a goodwill or any other intangible asset for that matter. But conceptually, this remains the same. What is impairment is when the carrying value is greater than the recoverable value of an asset. Let's say carrying value is 100, whereas recoverable value is just 80, which means I know that I will not recover, 20 rupees, though I'm carrying in my books 100 rupees, the recoverability is just 80, hence we want to write off the 20 as an impairment loss. So the concept remains the same. There is nothing which is changing from a conceptual point of view, but it's one of the biggest exercise which corporates are doing right now. I have seen some publications, not to take names, but I've seen recent publications and the press releases of some of the technology companies who published their results, just to check that what kind of impairment hit have they taken and what is a COVID-19 implication have they taken. There are mixed opinions. One set of technology company which published the results said, we see that there is going to be a hit and they've taken a hit in their financial statements. Another in technology company said, no, we actually got opportunity. In fact, in US, we got an opportunity to develop a new software very quickly to connect all the hospitals in one app. And then people are now able to find out, where these hospitals are connected. Basically, all the navigator apps is what they're developing. And they said, we have a huge work going on and people are occupied. And we see there is business models which are changing with our customers. And hence, we don't see that there is an impairment because we find that there's an alternative revenue we can generate. If not what we anticipated to generate, but we can generate an alternative revenue. So this is purely subjective. I mean, the two technology companies who have got two different segment of clients could get different results. So this is about impairment. Now going on to the next big area which will have an impact on account of COVID is, I'm sure most of you must be waiting to hear from the people who are researching on this area, that what should I do in revenue. I personally got calls from quite a few clients that how do I invoke clauses in revenue agreement, how should I now apply revenue standard. These are some very common questions. We do not have 100% answers, but there are some insights here. So what will change on account of revenue recognition? Okay, people who went to Ind AS would apply 5-step model, which includes step 1, identification of contract, step 2, identification of performance obligation, step 3, identification of transaction price, step 4, allocation of transaction price, and step 5, recognition of revenue. People who were not into Ind AS and did AS9 would have gone for a normal risk and rewards model, and the revenue is recognized whenever the risk and reward is transferred. Right? Now that we're talking more specifically from an Ind AS perspective, it has huge implications from an Ind AS perspective, and so as with AS perspective. But the proportion of the companies, in terms of the size, is more in Ind AS, and they'll have to revisit their revenue recognition implementation that they've done. So now, how do they need to revisit? Each step has got an implication on account of COVID-19. Let's say, for example, okay, step 1, identification of contract. Okay, when we identified a contract under Ind AS 115, we said there is an enforceability of an agreement and the contract exists, and the contract exists based on certain parameters. One, there is a future collectability of receivables. There's a hope that we will collect receivables, right? 2, there is no significant reversal of a revenue which is going to occur in the future, right? And there are terms which are very clear and specific. So we analyzed an existence of a contract within the ambit of the standard. So now what may happen, okay, some of the SOWs or some of the change orders or changes to purchase orders might be communicated obviously through emails or through, maybe they had a policy to have a physical signatures to constitute as a contract, but now on account of remote working and people are working from home, it's not possible to come together and execute contracts physically. People were now preferring an alternative modes. They may just say that in email confirmed, and as and when the situation betters, this execution will be signed. Now, this requires changes to their existing operational ways of identifying a contract. Now, the companies have to decide whether there is a contract or not, or whether there exists an enforceability of a contract given the situation and changes in which we are executing the contract. Now, the second point in identification of contract, collectability, right? So the contract was said to be existing on account of a future collectability. Now, what will happen on account of this COVID-19? No one knows whether the amount collectible is certainly collectible, or whether it is collectible, whether we will collect after a certain period of time, or it may eventually turn out to be a bad debt. So no one knows what's going to happen, what's going to be an impact. Now, one has to revisit based on the nature of contract that they had, that do I need to reassess the collectibility criteria, and do I need to reassess that whether there are indications that the contract requires a modification accounting. So this is a second point one has to look at in revenue standard. The third point, there are negotiations. Okay, there's a price which is agreed by parties on account of a pandemic. Now, I'm sure everyone is going through this. There are negotiations. There are big time, relaxations asked by our customers. The customers are asking to relax, SLAs. They're saying, can you please, give us some kind of reliefs? Now, this requires a revisit because there is a renegotiation of the contract which is happening. And as I mentioned, this renegotiation of the contract may be enforced or may not be enforced as well, because there is no really a physical presence to enforce anything. Now, how are they even renegotiating? It could even be only on a phone call. Right? They're just calling up and then saying, okay, let's go on. Or maybe on a systematic basis, it's recorded on an email. But is it sufficient as per the policies of that company to call this to be a contract, point number one? If yes, would this be a modification to our contract, or would these terms are so substantially different as compared to our original contract that it totally results into a new contract in place? Okay. Now, this requires an analysis from step 1 perspective. Now, coming to step 2 perspective, identification of performance obligation. Now, when one was identifying the performance obligation, there is not much which is changed from a performance obligation point of view, but on account of the negotiations which turns out during this period, there could be change in the way in which the deliverables are required to be sent to clients, right? It could be service sector, it could be manufacturing sector, right? I mean, the kind of deliverables might be re-agreed and renegotiated. So one has to look at, again, there's a modification. If there's a modification, we start from step 1 and everything has to be revisited to see whether there's a change in the way the revenue to be recognized. Now, the third important point is identification of transaction price. And this is where a lot of research has been going on, that what will change on account of COVID. Now, the point here, people are thinking is that, all these variable considerations which were associated with the revenue contract will definitely have a big change. It could be rebates, it could be penalties, it could be customer loyalty programs, right? I mean, just to give 1 or 2 examples now, airlines, how many people even can use those miles that they accumulated? How many people who book tickets would even be able to travel? How many, all of those points that the company has accumulated as a loyalty points, what will happen to those points? Because couple of days, they don't know whether this will open up and people can even use the points or not. Does Shoppers Stop, Lifestyle, all these retail industries, okay? I mean, will they get their gift vouchers? Will people come back and then exchange the gift vouchers? Will that just be expired now? So what happens to that kind of arrangements? So all of these requires a little bit of refinement and thinking. It could be penalties, right? Liquidated damages. The contracts are actually, the most contracts in revenue agreements talks about liquidated damages. There's a delay, you're getting a penalty. But now one will go to force majeure clause and invoke a clause and say delay is act of God. Okay, the virus is an act of God. We don't know whether it's act of God or an act of human, but we assume it is act of God. Now, if it is an act of God and then force majeure clauses are invoked, people are saying, we will not pay you anything. The contract temporarily is frustrated. Okay? Now, there's a frustration in the contract. The contract is void for time being. Hence, there is no execution of this particular clauses. Now, those are some things which needs to be relooked at it. As I was talking, I think force majeure is one common clause which everyone is thinking about. How do I invoke? We've been hearing in the news, which is already in the public places, in public, it's already been a public information that Reliance has invoked, PVR has invoked. I think as new as yesterday, I think we've heard Mumbai Airlines is trying to invoke force majeure clause and then negotiating that they will not pay rentals because it is act of God. Now, what is the answer? We don't know. It's very facts and circumstances, and in easily able to give an answer. It becomes a very legal standpoint. It is an ambit of a legal subject to see whether we really need to at this point of time call that this accounting can be stopped or not. Okay, so that's something is a legal matter. There's no answer right now, but there are quite a few conversations across clients on these clauses. Now that's coming from transaction price perspective. Now, coming from a fourth point, which is allocation perspective, again, I think it's not, it depends on the step 2. If there's a change in obligation, there's a change in allocation. Otherwise, I think we are good to go there. But coming to a last point, recognition of a revenue perspective, there are again a lot of debates going on. What may happen is something which was a percentage of completion method contract, which was recognized on a milestone basis on account of a negotiations or on account of a situation being not very certain. Does it require someone to defer the revenue until the event being happening? Because it's a contingency situation. Nobody wants to accrue an unbilled revenue when they're not sure about whether or when this revenue is going to be even receivable, or whether even I'm able to perform the obligation at this point of time. So this requires a revisit of the timing of recognition of revenue. These are some points from a revenue perspective. I actually noted quite a few. I mean, I think contract cost is one other area. If someone has capitalized the contract cost as an asset in their financial statements, thinking that revenue contract is going to be having a term of 5 years. Now, let's say because of the renegotiations, the term actually became 3 years. Right now, should I then amortize or impair the contract asset which is there in the balance sheet, because what is anticipated is not what exactly is going to happen? So that's one area one has to look at from a revenue point of view. I could think of onerous. Sorry, I lost the connect in between.
Yeah, I think we can hear you, Asha. Go ahead.
Now you can hear very good. Yeah.
Yes, go ahead.
Sure. Yeah, technology always has some glitches, especially to the people who doesn't like technology. It has more glitches. Okay, amazing. So moving on. Sorry, I guess there was a minute of a disturbance. Now, moving on from an onerous contract perspective, is the contracts are going to be a loss-making contracts? There is no clear guidance on at what point of time you will check the onerous contract requirement, right? Ideally, it is at the time of entering the contract. Now that it's a change in the indicator. Now, what we really need to do at this point of time, there is a gray area, but that's one thing the companies have to look out from a revenue point of view. Coming to an inventory perspective, inventory is another challenge. Like inventory valuations are going to be a challenge. Inventory measurements are going to be a challenge. Let's say there's an inventory which is on transit. Okay, inventory which is being received but not yet. We have received the goods but not yet received the invoices. There could be challenges on these kind of inventory models which are on transit or in possession with someone else. Should I now consider this inventory in the books of accounts or not? The second thing is an obsolete inventory because of the government intervention and the law prevailing in India. Only essentials are being made available to common public. But what happens if I had some perishable goods, or if I had some inventory which is not coming into the category of an essential commodities? The inventory would have become obsolete, requires a write-off from the financial statement perspective when we close this year end. There could be decline in the value of the inventory. The net realizable value of the inventory might go down. But how do we even now measure that? That's the biggest point. Like we say cost or NRV, whichever is less. But how do we even measure NRV in an unstabilized market? Because we do not know whether the prices which are reflecting right now are actual prices or not. Or do we even think whether this inventory is going to be fast moving or slow moving or non-moving? This needs an analysis. The biggest challenge, I'm sure Ajith will cover, I will not jump there, is an audit consideration and inventory perspective. 31st March inventory verification has not happened. The physical stock taking has not happened by the audit firms. Now, how do we even tackle? We might have to go back to an auditing standard 501 special considerations, right, with respect to an inventory, and then see what additional or procedures or additional considerations an auditor should do, considering that he's not able to present at the time of stock taking. One, the stock taking has also not happened. There are many organizations which could not even do the stock taking. Now, how do auditor and companies get up to say that what is the right inventory as at 31st March is one of the challenging area from a financial reporting perspective. Moving on. Another big area of discussion is an area of discussion on financial instruments. I would not complicate this for members, but one of the highly affected areas. If we just go through the balance sheet on the asset side and the liability side, there are financial assets on the asset side, there are financial liabilities on the liability side. There's equity on the equity and a liability side. Now, all the financial assets of the company either would have been measured at amortized cost, or it would have been measured at fair value through P&L, or it would have been measured at fair value through OCI. Now, considering the situation, if it is at amortized cost, it requires an impairment study to be done on all the financial assets. And we know the impairment is on an expected credit loss model, right? It is not a model that we follow for a non-financial assets like inventory or like fixed assets or intangible assets. So we need to follow an ECL model. Now, again, the question here is, I am not saying that the model is changed. The model remains the same, but the assumptions which have been fed to the model has to be revisited, right? The most companies would have gone from a debtors perspective, a waterfall model, just applying the aging or, applying the aging of the debtors and applying the joint probability to find out what is the provision on expected credit loss basis. Now, that requires revisiting because I'm not sure whether people will receive or whether that aging is do they want to do some forward-looking assumptions to that aging? How do they want to now find out what requires to be considered from that aging perspective requires a change? And if there's a discounting which is being done from an ECL perspective, applying an interest rate, considering the economy, the way RBI is acting, and there's a change in the interest rate which has been proposed, do I need to change my interest rate which is being used for the purpose of discounting certain provisions? That requires a close look. This, I don't think so. This session, we can just talk about ECL, and then it is very difficult to even say how one want to do ECL, but it's judgmental, requires revisiting of assumptions. I've been getting questions from a lot of organizations that how do we remeasure these models? What kind of assumptions are you thinking? What is it we need to put into the different models? Should we get a help of a valuer? Yes, if you want to get a help of a valuer, what will even valuer talk about? Because even he doesn't know what's going to happen. He has a curve which is established with a general pattern, but this is not something which is a normal economy. This is disturbed and a frustrated economy. How do we now change those assumptions which is coming through a valuer? So these are some questions. I'm sure, as we go into each disciplines, valuation will have an impact. ICOFR will have an impact. IFC will have an impact. SOX controls will have an impact, so on and so forth. Each discipline of our profession will have some degree of an impact on account of COVID-19. So this is from a financial instruments perspective. A lot of more thought processes arising in the market on financial instruments, amongst the finance professionals, accounting professionals, to be specific, that how do we now do fair value measurements? Let's say we did level 1, level 2, level 3 classifications based on observable inputs, unobservable inputs, and based on certain valuation models. These observable inputs are no more observable because stock markets are disturbed, right? It's not a reflection of the economy. Now, how do we even consider these observable inputs as level 1? So this is the way the measurement of the fair values were done earlier requires a little bit of thinking, and whether the valuations that which is done from a level 3 category of a measurement, do we need to reconsider those valuation is another thought comes because of COVID situation. Biggest impact is discount rates. Financial instruments, I'm sure the one on this live webcast who are listening to us, have done financial instruments standard workings. The most of the workings of the financial instruments are derived based on a component of a discount rate. That is one of the essential input to financial instrument computations. Now, discount rate will have to be reassessed to see whether, whether this requires a reassessment and the prospective way of accounting things. We need to do a catch up in terms of change in the discount rates, because this discount rate may not be a reflective of what has happened. Now, the point here is generally what we used to do, we used to take a discount rate at the inception of the contract, and we'll continue to do it at till the maturity of the contract. But now, considering that that's not reflective of what is happening in the economy, how do we now revisit these discount rates and change the computations is one thinking from the financial instrument standard. Effective interest rates, EIRs, okay, because of the renegotiations amongst the bankers, investors, and the corporate community, there will be change in the interest rates which has been agreed. There will be change in the contractual terms. Now it may result into a new transaction cost being appearing. And hence, this will have an impact from financial instrument perspective. Again, big standard to watch out. The companies who actually were very close to financial instrument implications might have to look at financial instruments closely. In fact, one of my friends was asking me whether we should impair now only debtors or we should impair everything. The answer is all financial assets are subject to an impairment study. May it be security deposits. Now, will we even get back our money? Okay, will the security deposit that we have given, would it come back to us? Requires assessment. May it be deposits, right? May it be, I mean, I'm not sure about bank deposits, no comments, but I'm talking about deposits with the other organizations. Will this come back? Right? Will it be any kind of, any kind of an asset which has a contractual right to receive cash? Now we'll have to see whether this contractual right is disturbed or frustrated on account of a situation. Now, do somebody even go to force majeure clauses there and then say that, no, we will not give you now because this right is only for a normal situation and this situation doesn't demand anything to be returned. So now this requires a close watch by companies. The contracts requires to be relooked at it. Now, the three standards that we spoke about now, impairment, revenue, financial instruments, all the assumptions and the inputs which will be changed on account of the COVID implications has to be disclosed in the financial statements. The biggest concern that I'm hearing amongst the corporates are, how do we draft these disclosures? Okay, we want to wait for someone to draft it and we would want to start from then, but it's very difficult to maybe at this point of time to standardize the disclosures. Unlike in, when the standard was implemented, financial instrument standard was implemented as part of an NDS implementation journey, some of the disclosures were quite standardized. We would not really, would have made too much customization into it because this was quite straightforward disclosures. But now that may not be the case. Companies have to closely watch the economy. How are they impacted on account of this, and how is the economy reacting, in their sector? And then the disclosures have to go quite specific to their sectors. Okay, so it needs enormous efforts from the management and from the people who are charged with governance to refine the language which goes to the disclosures, because this will be closely watched by the entire stakeholder community. Yeah. Another point that I could think of from a financial instrument perspective is loan covenants. We classified the loans as long-term loans, though there were covenants, because Ind AS had a relaxation in terms of classifying the loans into long-term and not showing it as current. But considering the impact on account of COVID, if there is a trigger that this covenant might be invoked or might be challenged, then one has to relook at whether the loan classification has to be relooked at it again from a current and non-current perspective. So these are some points that I could think of. Another point that I could think of is, would these huge amounts which may go into the financial statements on account of the implications of this scenario, would one want to call it as an exceptional items and carve out from the profit just to not to disturb the normal profit and showcase that all these changes are on account of an exceptional situation? So this requires an evaluation that can the presentation of this volatility be treated as an exceptional items in financial statements. Hedge accounting, another area of implication. Someone who is close to this area of hedge accounting, there is level 1, there's level 2, and there's a level 3. I'm sorry, there's cash flow hedge, there's a fair value hedge, and there's net investment hedge, right? One has looked at, when they did a hedge accounting designation of the hedging instrument, either the hedges were cash flow hedges, where it was highly probable forecast transaction, and accordingly the hedge was considered to be effective. Now, considering the situation, will this be highly probable forecast transaction is a question by many companies. Okay, the sales that we forecasted, will this sales, the numbers, the forecasted numbers are going to remain same, Obviously not. Then if there's a change, what is a change? And because of these change in the forecasted numbers, would we have an impact on account of hedge effectiveness testing? Most of the publications that I've glanced through and the conversations that I have had, people are saying that there is going to be definitely a degree of impact on hedge accounting testing, right? Which we do, effectiveness testing that we do from a hedge accounting perspective. Fair value hedges, again, is a close watch, because fair value hedge is actually marking to a fair value of an asset or a liability. Now, the fair values are so volatile, so tentative. We do not know how this changes. As on 31st March, what is a crystallized fair value to call it and account for it? Nobody can crystallize a fair value because it's highly volatile and hypothetical. Right now, how do we, one then has to go to fair value measurement standard and see if the market is not a close reflection of a fair value. Should we now take another parameters to compute fair value? Should we take, let's say, cost as a fair value approach, or should we take, whatever is the inputs available with us to compute fair value? But this is a huge burden to many corporates right now. They're thinking that the market-based approach that we adopted under Ind AS 113 may not be a reflective fair value measurement currently. So therefore, what do we do now? What kind of a models we switch on? Okay, what is the best available price in the market? What is market participants using? Are big questions in the market. I am just throwing up the insights. Do we have answers? We're all thinking through. There is no one answer to any of these questions. And hence, I think I repeat that in my view, this requires a proper accounting change assessment. We need to just go through each standard, document what really changes, and then conclude whether there is an impact in terms of a quantification in the financial statements or not. Yeah, banks and NBFCs, I think this moratorium period that the banks are offering, how do they need to account for this moratorium period? They need to talk about that there could be some restructuring, which may happen on account of, COVID implication. In US, this is called as TDR. They call it as troubled debt restructuring. US GAAP has specific guidance on TDRs, which to an extent even IFRS or Ind AS provides a guidance on restructuring, but something which could be concluded as restructuring requires an accounting as per the restructuring principles. So one area to watch out for banks and NBFCs. I'm now going to another biggest area of an implication on account of COVID is leases. I could immediately think of some retail companies which has impacted, on account of variable lease payments. They had a fixed minimum rent, and the rent was based on the percentage of sales the retail companies, or maybe for that matter, franchisees or huge chain organizations were achieving. So on account of closure of most and almost everything other than the essential related items, we can imagine that the leases is one of the biggest hit standard from a lessor perspective as well as lessee perspective. Similar conversation that we had from a revenue perspective has to be looked from a leases perspective as well. Are there going to be changes in the contract? Are there going to be modification in the contract? Right? Is there going to be change in the lease payment going forward? If yes, is there going to be impairment to a right of use of an asset? Because when we computed ROUA, our cash flows are determined based on the agreement at that point of time. Now, if there's a modification or if there's an anticipation that we may not get that lease payments, what should we do with an ROUA? Should we impair it? In fact, I was reading very interesting guidance. It's actually called, even if the contract is not changed, there are oral conversations amongst the stakeholders not to pay lease rental. So lessor is calling up a lessee and said, okay, I understand. We have a very good relationship and you have been partnering with us for a while now. So this 2 months, we are waiving off your rentals on a pure relationship basis because you're not doing business. It's unfair for me to demand rent from you. And hence we don't want rent from you. Now this triggers an accounting implication. From a lessee perspective, it's a lease incentive, right? It's something which is given from a lessor, from a lessee side. How does lessee should record this lease incentive? Should it then be called as contingent income? It is kind of an income which is on account of the situation that we are going on. Should we record it as an income? How do we treat that? From a lessor perspective, how should he treat these lease incentives? Those are the questions which are arising. In fact, though there is no change in the contract because there are oral conversations or written emails which are happening between lessor and lessee, the points which are emerging in the market is that a de facto, does it result into a de facto accounting? Should we just account because of the conversations? Should we change our accounting, or should we wait for contract to change? Okay. Now, these are some thoughts that should we get into. Should we get into de facto kind of a model and then assume or deemed to be, an accounting and then do an accounting, or are we waiting for actual execution of our contracts to comply with this accounting? Is another question which is going on right now. If you look at, I think from a leases perspective, I could think about new leases is okay, but I think from another important point I could think of is lease term. Negotiations could change lease term. Another important point I could think of is IBR, right? Incremental borrowing rate, which is used for discounting lease payments for computing ROUA. Now, this will have an impact. The incremental borrowing rate is having, is changing on account of the changes in the interest rate across the market. In fact, most of us are aware that, IBOR had some implications on the interest rates in the market. The change in the IBOR actually is going to have some implication. Interbank offer rates, right, are now being slowly moving to a reference bank rates or an alternative bank rates. That itself had some thinking in terms of what should be an IBR or incremental borrowing rate in the market. Now there is much more thinking that what should we at this point of time consider as a discount rate for computing leases. Another area which comes up in leases is whether for a lessor would this lease be onerous. Okay. If a lessor is anticipating that the business models will change, as Ajith mentioned earlier, we don't know how people will react. I was asking one of the CEOs that, so what will happen after this pandemic gets over? Would you just prefer having working from home? Because it saves infrastructure costs. Now you've already incurred huge amount of expenditure to get the work from home up and running. Would you then just change your culture to work from home? Now the CEO whom I spoke said, culture definitely matters. We don't want to have work from home because it doesn't create a culture. The whole reason why, this corporate is the corporates came up, the lifestyle changes happen. And why did we get into this kind of cosmopolitan economy is because it creates a culture amongst the organization. So his view is we don't want to change our culture, and hence we will not change this work from home culture at all, even going forward. Though I agree we incurred a lot of cost to get the remote working facilitated, but it's going to be a sunk cost for us. May help us in the future from a BCP perspective, business continuity plan perspective, but we don't want to do it. But that's one school of thought. There could be people who must be thinking, why should we even incur? People are now up and running and working at home. Why don't they just work from home? I am just thinking, my guess, though I have not read anywhere, that my guess is it may so happen that the freelancing may become more common, where people actually become, the resources ideally may go on a subscription model, where, there will be a portal where I'll apply that Asha is available for 4 hours, and, 4 hours of the work I'm ready to take from a consulting point of view. And I book the 4 hours and utilize the rest of the time to do any other work. May also come up. We don't know what kind of resourcing models will emerge going forward. It could be subscription models, or it could be full-time models, or it could be work from home models that one has to look at, because lessor is little in stake now. The heavy infrastructure which lessor has done into getting his property, into a very lucrative manner, he has to look at whether the lessee to whom he is associated is even thinking about changing the business models. Going on, I think going forward, I think I will make it quick. These are the 4 big areas I wanted to touch upon as an interested areas for organizations who are closing 31st March reporting. We have some relaxations and extensions, but having said that, we have less time to think about these implications, document these implications, walk it through the auditors, convince investor community, convince ourselves. This is going to be a time-consuming task, and organizations have to start immediately thinking in these lines. Accounting estimates, another area which will change. Deferred taxes is another area which will have an impact. Let's say somebody created a deferred tax asset considering that the the taxable profits will come up in the next couple of years, and hence the asset is going to reverse in X number of years. Now, considering the economy, the way it is going, if they expect that their estimated profits itself are going, if they've expected their profit on a growth basis, what is the growth that they've expected? Will it happen? If they expected their profits on a static basis, would that even happen? Whatever I expected, will I achieve what I expected, or should I need to take a haircut in my profits? Or what should I do is the question from a deferred tax perspective. Deferred tax asset requires revisiting in terms of how much can be called as asset, in the books of accounts. Some of this, until I read, very deeply, I never thought about that some of the impacting area could also be depreciation on property, plant, and equipment, because most factories are shut for like a month now. It takes a while for them to get their property, plant, and equipment and machinery running. In fact, I think we are seeing some hilarious videos on the social media in terms of how airport will work once it starts. Will the aircraft will even start? Will somebody has to push the aircraft? What is going to happen to the aircrafts after the airports are open? And the same question will emerge everywhere. What will happen to the machinery which has not been maintained for a month, which has not been lubricated for a month? How is it going to impact? And should we take a hit in the useful life of the asset on account of that? Right? Provisions. Should we create provisions on account of COVID-19 implications? So these are some points of thinking from a financial reporting consideration. I will now move on to maybe 2-3 quick areas. Government grants. We spoke about it in brief. If the government is giving relief, if the government is providing waiver of loans, if the government is providing moratorium, if the government is contributing additional funds to make better the organizations who are suffering very badly on account of COVID-19. Now, how will we account these government grants? Nothing is changed from a standard perspective. I will still have to go back and look at the government grant standard and recognize whether it's a revenue grant or capital grant. But the challenge here is there are grants which are quite unique in nature, which we have not dealt earlier. So all the grants which are coming on account of COVID scenario is something which we in our profession so far have not dealt with. So we need to closely assess, estimate that how do we record these government grants in the books of accounts. Borrowing cost is another area. If I have a loan and if there's an interest and the construction is stopped now, it is suspended, it is an abnormal situation, I need to also have a suspension of a borrowing cost. I cannot capitalize interest for an abnormal period. Right? So that is one area of concern for organizations who are doing capitalization of borrowing cost. I could quickly see, I think I will go through the comments. I think, as I complete and then Ajith takes over, I will come back to the questions. But I could quickly see one question about, can I touch on subsequent disclosures? Yes, I have that slide. I will come to that. Financial statements going concern, assessment requires revisiting. From an auditor's perspective, SCA 570 requires auditors to perform procedure with respect to knowing whether there is a material uncertainty over going concern, and how does that get addressed by the company. Then maybe this time audit reports we will find auditors commenting on the material uncertainty over going concern, especially the organizations who will suffer to even come out of this situation. They may have to do a liquidated accounting, breakup value accounting, and they could emerge into a different accounting to be done for companies who have to shut down. So that, cross fingers, God's grace, it should never happen to our economy. There are lots of MSMEs and SMEs on which the economy is back. I was watching a TV show where they were showing the slum in Mumbai, and it was so disheartening to see if something happens in that slum and if some people gets affected, the entire a very small sector which is a backbone to a Mumbai exports is going to heavily be impacted. We should just pray God. As I'm talking about these auditing points, it's definitely not easy as a person for me also to take this, because everybody is going through tough times, and we should just wish that no one will even come to this going concern impacted zone. I think assessment is fine, coming out of assessment is fine, but I think just hoping that we will have less cases, but across the geographies that I'm reading, especially US that I'm reading, US has already introduced a bankruptcy procedure on account of COVID-19. They're already introducing something around fresh start accounting. So US is thinking that quite a few organizations who could be impacted on account of going concern. So we should just wait and watch how will this turn out to our economy as we go with the time. To someone's question, events after the reporting period. Now, this is very interesting point. 31st March 2020 is a reporting period for Indian companies. I will not give an answer, with the professional, judgment, because it's an area of a judgment. But having said that, okay, fairly settled positions are also available. That 31st March 20, India already knew that, there is a COVID implication. There was a government order on 23rd March to lock down the entire country. There was indications on 22nd March, to say that we need to just do 1 day lockdown, and then extension. So they were already, they were already government orders. There were evidences available sufficient on 31st March that there is going to be an implication on account of COVID-19. So now one question one would ask is, should I take these events, okay, as an adjusting event? Now, if I come to know in the month of June, when I'm closing the financial statement, that this has impacted me big time from a receivables perspective, I am losing, let's say, 30% of the receivables on the balance sheet, which was there on 31st March. I may not receive these receivables. Then the point which comes up is, what will happen now? Should I adjust this as on 31st March? Should I treat it as an adjusting event? Now, if I treat it as an adjusting event, it requires an accounting as on 31st March. For some economies, it is not an adjusting event. For example, the ones who had 31st December as a closure, maybe because of 2 subsection 41, somebody who took an advantage of a financial year change, or some companies who are, having their arms and geographical extension in countries outside India, who are reporting as on 31st December. It's very rare that one would say there was an indication on 31st December, because till then only China, I think, had some cases which were until end of December were not very, very been aggressively known to the entire geographies. So in those cases, one could actually say there's only a disclosure required. If I look at some of the US financial statements that I've gone through, because US follows 31st December and it's already up, annual reports are already up, right? All the 10Ks are already up. So when we look at it, I think they have given a disclosure around how COVID may impact them, but impact will be taken in this Q1. Even the markets outside India have taken an extensions in the reportings and filings. So we'll have to see. There were 5-6 companies that I could see in US who have got Q1 release, and the impact for them was quite significant on account of COVID-19. So India, we'll have to see, I think, as and when we move on, closing this particular quarter, how would people look at April to June and make those changes, especially in the month of July. So all of this that we are talking, one from a 31st March perspective, are important, but it also becomes very important from a first quarter close perspective. I think maybe we can, with the cooperation of the institute, we may want to just revisit in July to see what are all the maturities happen in these areas as we move with the time. So disclosure considerations are pretty big, though. I think every standard that we spoke about requires disclosures. I will not call out this, but it could be sensitivity analysis, it could be discount rate, it could be change in estimated life of an asset, it could be modification of the contract, it could be change in the performance obligations. Everything that we called out in the last few slides requires disclosures. So this was this brief summary of the considerations. This is definitely a deep dive. We do not really want to bore with too many information or too much information at this point of time. The idea was to give you insights, and maybe you're thinking about few areas which you should be immediately considering when you're closing 31st March, and also be proactively informing your finance teams and informing your staff that have an eye on how will April to June would move on, because it's very difficult to research everything together. One has to consciously prepare early for this 3 months to see what implications will come up for Q1 as well. So this is a bit for me. I will read through some of the questions meanwhile, and we will answer. Over to you, Ajith, for audit considerations.
Yeah. Thank you, Asha. That was actually great. So I think for all the participants, in a way, if you look on all the key impact areas for the financial statements, you can fundamentally put it up into two buckets. So one is, anything that is having an impact on your estimates or say your future forecast, all that will have an impact, right? So be it you are talking of impairment, be it if you're talking of revenue or say leases, or for that matter, even your financial instruments, your expected credit loss impact, all that is having an impact that is basically on your estimates or your judgments or your forecast, that will have an impact. Other side is your fair value movements as on the balance sheet date. So that is anyway, it is not because of COVID-19. We are only looking at as on the balance sheet date because of this COVID-19. Is there any impact or not? So anyway, fair value movements will be there, but only thing this time there could be some adverse movements. So these are the two buckets actually which predominantly it is all revolving at. Now actually coming at the looking onto the audit considerations, which is actually very, very important. As companies actually deal with the above issues, we all know that all the employees are all working from home. So when you're actually telling all the staff are working from home, it is both on the company side and also from the audit side. Many of the entities have already started discussions with the auditors. I would actually recommend and urge all companies to start discussions with your auditors, because I think please we need to think from the other side as well, because the auditors also will have challenges in completing the audit in time. So one is we will find that audit team may issue they may actually have challenge to determine all the appropriateness of all the management estimates and all the assumptions what you have used, right? Second thing is that the expected timeline, so like the way I would have expected in the previous year, may not be that it could be the same in the current year as well. So because the timelines of audit actually can change. Companies which have different locations from where they operate, like say for example, like if they have actually various subsidiaries, associates, or different branches, factory location, warehouse, depots, I think all this will have an impact on the current year audit. Another very, very important area is on the entire the owners on the entity to demonstrate how the internal controls, that is a financial reporting, is actually effective. Because given that many of the staff have been working from home, the entire remote close, that is the financial statement close process as we speak, many of the controls could be compromised. I'm not telling that it will be compromised. Many of the controls could be compromised. So that will also become an area of challenge for the auditors. Other specific areas is, I think, which Asha already touched upon, is some areas like your inventory count. I think inventory count, anyway, the year end 31st March is already gone. I think once the operations are resumed, I think the first thing which the entity will have to do is actually do an inventory count and do the rollback, actually do the rollback test on that. Two important areas for the auditors for this current year will be on the entire area of your going concern and subsequent events. So subsequent events, definitely as far as India is concerned, it will be a area of concern, because for at least for all the US and UK companies, if you see most of the financials, they ended on 31st of December. So for them it was a kind of a subsequent event. But for us, as if given that we all have the financial year end on 31st of March, this will become a very, very critical area to actually assess on whether any of my assets or liabilities will undergo a change by the time the financial statements are finalized. So this will have an impact. Another area is on certain audit procedures which the auditors normally do it every year. One is on your confirmation of balances, that is your debtors confirmation, creditors confirmation, how these things will be done. Okay, and what if that is not done, then what will be the alternative procedures an auditor will have to actually perform in the current year. So you will have to all this actually discuss with them hand in hand, to see that you don't actually lose out much of time in finalizing the accounts. Another area is also consideration in the audit report. You will have to well discuss this in advance to see that whether there could be any emphasis of matter, any adverse opinion, or any other comment in the audit report which could have an impact on the entity. So that is more from a audit consideration point. I think I will also touch upon on some of the important things which from an audit committee per se, which entities will have to take care, especially for the listed entities. They will have a challenge now in convincing audit committee in how did they actually get access to the data, how did they actually ensure that all the internal controls relating to your financial statement close process, all that is taken care during the year end when the financial statements have actually been prepared. So that is one very, very important area for entity to actually work on. So that is one is, for the entire top management. Then the second area is for all the compliance officers to actually demonstrate how everything has been taken care. So this audit committee will be one with very, very important role, which, entities will have to think on. Now, lastly, actually, getting on in the interest of time to some of the recent regulatory relaxation that has been given by the government. I'm sure most of you all might be aware of this. It is only for your knowledge, where we are just actually highlighting this. So, and as you all know, all the quarterly filings, which was actually due on May 15th, that has been extended now to June 30th. And then your, again, your annual filing, which is actually due on 31st of May, again, that has been extended till 30th of June. They have actually given relaxation on your IT return, GST return of 18, 19. This has been again extended till the last week of June. All the REIT and InvIT entities, which had a due date of 15th of May, again, that they have extended by one more month. That is now 15th of June now. And as we speak, like many of the other relaxation as far as your secretarial compliances are concerned, like say, mandatory independent directors meeting, that can be done away with it. It is not that it can be done away, it will not be seen as a violation. So which means that now even all your video conferencing meetings are allowed, and even this will be counted for the purpose of quorum. If you remember, the Companies Act did specify that for the purpose of approving your annual financial statements, the meeting could not be actually done through a video conference. So that also can be done now. What at least we are getting to hear is many of the companies now, the board meetings, the quantum of board meetings have actually increased because board of directors are feeling now more comfortable to have meeting through video conferences. So, and I think the whole point is, considering this entire uncertainties involved, it is important, that the finance and the compliance team, communicate regularly with all the stakeholders, including the audit committee, auditor, the board members. And companies should expect a greater level of challenge from the stakeholders. And this challenge is essential to ensure that financial statements are, accurately capturing all the impact of various risk and uncertainties involved. And in certain cases, auditors may not be able to perform mandated audited procedures, which we mentioned, and this may all result in qualification in auditor's report. So an entity needs to be mindful on these areas. I think coming to the last part of this session is, like on how entities are actually gearing up during this COVID time. So we all know that, many of the entities have been doing this work from home. VPN accesses have been given, access to the entity network have been given. Many entities have actually, set up virtual command centers, virtual help desk to ensure that all the to ensure that all the employees are full time connected. Most of the remote entities already had something called a close calendar. You could call it as a close calendar, or you can call it as a financial statement close process checklist. Many entities are actually revisiting this to see how the timelines needs to be changed, what process needs to be changed, how do you have a daily kind of a review meeting now, given that the entire finance team is sitting remotely and actually closing their books of accounts and preparing the financial statement, standardized templates, to enforce procedures. All this has been actually done. Many entities have become very, very active in providing adequate training to their finance staff. I think they are using this time very, very effectively, during the morning times and during the evening time, to ensure that, they also stay abreast with all the recent developments and the regulatory development that is happening. And many entities are also considering the need, to involve all kind of reporting specialists at this point of time. So that's it from our side. And now actually I would recommend the coordinators to open this to the questions.
For the questions. Yeah. Thanks, Ajith. I think to add on, this remote close is one thing which across the geographies people are considering. So I've been now close to global markets because of my work profile. Where I've just shifted to be a little more close to global markets and interacting with the global accountants. It's an amazing experience. In fact, someone just messaged me that you look very tensed in the session. Asha, it's been a roller coaster, absolutely overwhelming. We don't know when we start a day and when we end a day. It's been, I'm sure Ajith will agree. I thought work from home will be very fun and then I can spend time with kids and, we can have all of the fun. We thought work from home is actually work for home, but eventually it did not turn out to be work for home. It became completely work from home and dedicated, extended hours of work is going on. So that little bit of, I think you will find the stress with us, especially I'm sure Ajith will also agree, all of us are like really extending because the kind of changes which this COVID is getting and the kind of questions we get with stakeholders, being in the profession, we have to be really up and running, have the answers, read through. There are very good publications. If some of you are interested to read, McKinsey has come out with very good strategic publications. BCG has very good strategic publications. Having said that, in Earnest and Young, every day there is one or the other publication which is getting released. Same with other big four as well. We have multiple informations available on this subject. Everyone whom I'm talking is working days and nights on research, may it be clinical side, may it be accounting side, may it be taxes side. And I think that's how I opened the session to say that, we find opportunity in everything, right? We want to learn in everything. Whether, what virus is doing outside, we really have no clue because we are busy learning by ourselves. So that's I think, a good thing, I think, for our profession. We always learn.
Again, at the end of
So
the day,
I have,
this
yes.
is only a transformational change. I think the entire the work culture, the way how we do business, the way how we do work is going to change at the end of the day, and I'm sure that is changing. Like say for a very simple example, if you look even at home, many of the schools have actually conducted Zoom classes even for primary kids. We never
Yes.
even thought of this.
Yes.
Right? So which means that going forward, and just trying to think aloud, that Saturdays schools may not be for kids. They might tell that Saturday classes will be only on Zoom.
So, no, I think that is a big thing. So I was hearing Raghuram Rajan's 1 hour interview, right? And he was saying Harvard has actually converted 85% of their courses on online, and they're now ready to do any kind of online classes. We're like, if that happens, then people who used to go to Harvard to learn now can learn from anywhere. So now the question is, oh, that's a big topic by itself, Ajith. You rightly picked up that, what kind of disruption or transformation will this bring into the thinking of business models? If some of these big B schools can do classes virtually, I think everybody will do. Another new normal we are finding is, I'm sure all of you are experiencing is, all my video calls, my kids are at the back. Okay, now it's become a new normal. There was a time where we were so formal, we wanted to really maintain that distance, but being at home, the whole family is known to the whole office now. So that's maybe a good part of it. I think we are socially distanced but socially connected as well. So yeah, so as I'm doing the session, I'm hearing banging the door like at least 100 times by now. So I can see the session is open for questions. Now I have 2-3 questions on this. Arun Chandrasekhar has a question. Could this be boom period for private equities, though structured as a BDC? I think if you're talking about business development companies who are investing in the private sector, not very, very certain to say whether it's a boom period, but yes, there is a bargain purchase which has been going on in the market because the securities are stressed now. People are thinking actually to invest in the security which is stressed, and maybe they're thinking it's a good time to negotiate better, and accordingly they're thinking there is a lot of thought process on this kind of organizations, but I wouldn't really comment whether it is boom or not for them. So that's something which we would want to see with the time. But there are conversations for them to reopen M&A transactions, okay? Because M&A is halt now. Maybe new markets will be open and new investors are venturing out to see what kind of equities that we want to put in, because now it's a stressed market. People really want to see how can they take advantage of this situation. More than an advantage, I might say maybe opportunity out of the situation. So there is a thought. Ajith, you want to add on something?
Yeah, that's fine. Yeah, I think even from a BDG company perspective, even if they acquire a stressed asset, The point is, at this point of time, we do not know whether the stressed asset will become even more stressed or not. We do not know how it is going, right? So yeah, I think that is again, finally, you just need to only wait and watch, and I think hopefully everything will be fine.
No, agreed. Yeah. We have another question, I think, which is also from Arun. Most of the level 3 investment valuation is done using EBITDA multiple. Will this situation create a shift to a different metric? If yes, what is most suited? It's a very good question. This is a thinking which is going on. If you have done something on a EBITDA multiple, then ideally EBITDA being a non-GAAP measure, so there is quite a good amount of guidance available, from the US markets perspective on this, that how do you make an adjustment of a COVID-19 situation to an EBITDA multiple? If you're doing EBITDA multiple, I mean, I would think that you will continue to do that, but what is important is how do you make those EBITDA changes right now?
And also, this will have a impact on what the market participant actually wants. So if you feel that, ultimately the valuer, when he's doing this, or when whoever is doing this valuation, if you feel that EBITDA multiple is no longer, a criteria to be considered for valuation, then you'll have to change the method. Then probably you should ideally go with any other, you use a market approach, or you use a cost-based approach for your valuation. But the whole point is that whether, as long as your cash flows are positive, then you need to still evaluate whether you need to change the method. It will still continue the same, because that will be a more reflective of the actual valuation.
Perfect. So in fact, if we go to the standard says whatever is the best available information. So I think that's where one has to now draw the analogy that what is available right now with us is a good measure of measuring the fair values. Yeah, can PPT be shared? Okay, we have some, I think, which we will do it, I guess, through ICI. We can open the forum for any other questions. We have maybe 4 more minutes for few questions. But I'm just hoping that this was useful. We thought, we were also not 100% prepared on the topic, but then I spoke to chairman and said we should just do this, because it's good to just brainstorm and then, continue with the deep preparation on this.
If no questions, we can conclude.
Sure, sir.
Hello?
I think we are.
Yeah?
Yes, we can. Yeah.
Yeah.
Sure,
we are good to conclude.
Yeah. It was excellent.
Flower bouquets, Srinivas, sir. Saying we are missing the flower bouquets. I used to carry and keep it for 1 week. So.
No, we are missing to meet you people personally also, because it was an excellent session. You have brought up so many points. Really, it was very useful. See, so many critical aspects what we revisited at the time of reporting, disclosure consideration, audit consideration. Even if you see face to face also, we may not get so many points. Within 2 hours, you have covered so many points. It was really a fantastic this thing. I think this is a very challenging year. This year, I think, because a lot of value addition needs to be given for this preparation of financial reporting this year, I feel, right? Can you hear me?
Yes.
Absolutely.
Yeah. It's really a learning year. If we succeed effective reporting this year, definitely we can report in any kind of situation, I feel. I really thank both of you for your efforts, sharing your knowledge. I thank on behalf of Bangalore branch of ICA. And also thanks all the viewers. There are more than 270 members watching our program live. I thank you all. Thank you, Asha, and thank you, Ajith, on behalf of Bangalore branch of ICA once again.
Thank you all so much. Stay safe and take care of yourselves.
Thank you.
Yes, thank you so much. Wish all a very good health and safety. Stay safe. Hope to meet all of you, I think, in the ICI Bhavan again. I think that's always fun. I mean, how much ever we enjoy this virtual sessions, meeting people is always, always a great thing to do. So hope to see all of you, and hoping for a better, economy soon.
Yeah,
Thanks
even our members and faculty see positivity even in negativity also. They will learn meeting you people through webinars. Thank you once again.
Thank you so much.
Thank you. Take care.